listen, if this continues to play out in the way that we think and the trend continues, there is no reason global GDP can't double in a year and even double in a week. But that's what's coming. This is what I think gets us out of the debt trap. This is the whole idea of this exponential age thesis that I've got, is this nexus of technologies all hitting exponential adoption phase at the same time and kind of interwoven with each other, drive a productivity miracle, far and away larger than the one observed in the 1950s and 60s, which also got us out of the debt trap then, the post-war debt trap. Very similar situation. And it took us a while, a bit of yield curve control plus new technology. This time around, we might get yield curve control, but the new technology is really going to change everything.
The synergy between economic recovery and crypto activity is projected to intensify. Raoul Pal anticipates that as economies regain momentum, crypto markets will thrive, fueled by increased spending and demand for tangible assets within the digital economy. This prediction is based on his latest research, which suggests that despite prevailing market conditions, there's an underlying momentum primed for acceleration. In a rapidly evolving landscape, marked by interplays between global economies and emerging technologies, Raoul Pal discusses his investment strategy with a keen eye on Bitcoin and crypto, and believes the forward-looking indicators in the market will bring massive gains in the coming months. He also believes central banks will play a critical role during this season as well, as their printing practices always play a pivotal role in the crypto domain. And as economies decelerate or interest rates soar, the likelihood of rate cuts becomes more plausible. This isn't confined to the United States alone, but will affect markets globally. Let's get into the latest interview with Raoul Pal, as he gives his latest prediction for Bitcoin, the crypto market, and where his investment strategy is aimed in 2023. Don't forget to share your thoughts and comments down below, and leave a like if you enjoy the content we do here.
I think people are confusing current economic conditions with the recession that they desperately want versus the markets discounting it, the forward-looking stuff like crypto and tech discounting it in 2022. They all had raging bear markets. Right now, we've got the Russell 2000, oil, copper, all of these things in present day slow economic conditions. Do we get a full recession or not? Doesn't really matter. It was priced in the stuff that I care about. But the forward-looking stuff, all of the forward-looking indicators from ISM are all pointing firmly higher. So we're around the trough of the cycle. Doesn't mean inflation picks up from here. In fact, because inflation's so lagging because of owner equivalent rents and wages, that it should continue to deflate all of 2024, particularly at the core level. And the headline level, we think, continues to fall. So, we're still of the camp that headline inflation probably gets to zero next year, and core inflation too, which I don't think anybody's prepared for because everybody's on the sticky inflation camp. Now, let's worry about inflation in the next business cycle when it heats up, not at the beginning of the business cycle. That's the macro summer, spring to summer transition is generally falling inflation, rising growth. And that's what we're seeing. All the forward-looking stuff is clearly macro spring into macro summer.
This is not a late cycle dynamic, is it?
No, this is early cycle. It's exactly as it should be. So we've had the ISM troughing, all the forward-looking indicators pointing up. The business cycle dominoes mean that the things that the Fed look at, inflation and unemployment, are the last shoes to drop, which is why they've been very slow on this cycle. So what they will see is unemployment rising somewhat. Nobody expects a massive rise in unemployment, but a bit stickier. And I think AI and stuff like that will make it stickier. I don't think most of the jobs lost in Silicon Valley are coming back. So people have to reorganize themselves and to find different work and stuff like that. And then inflation, I think, continues lower for, at least next year. And then it'll start picking up again, as all business cycles do. And I don't know where the story that it's the 1970s all over again comes from, because I don't see it anywhere in the data. Of course inflation will pick up next time. Of course the year-on-year effects will make it look stronger. So we will get a rebound in inflation. But the reality is if you think that wage earners have the power versus a world of AI and robotics. I mean, that's a different world. This is not the 1970s of your parents.
With an air of urgency, he also highlights the mounting concerns encircling the colossal $6 trillion debt maturation slated by year-end. Amid this fiscal tightrope walk, Powell discusses the economic indicators we're seeing, as well as the debt dynamics and the pivotal role of central banks in shaping the market in the last part of the year.
And every business I speak to is now starting to utilize AI. And that means that they will hire less. Doesn't mean they lay off people necessarily, but they'll hire less in the business cycle, which is fine because unemployment's pretty low right now anyway. And we've seen that kind of behavior in Japan. Unemployment stays low regardless of the cycle because the labor force shrinks, and the labor force shrinks in the US for the same reasons, demographics. But really how you need to frame AI is, okay, GDP growth or trend rate of GDP is driven by population growth plus productivity growth plus debt growth. Now, debt growth stopped in 2008. All debt growth now is really servicing of old debts. It's the ongoing repayments of debt cycle. Productivity growth and population growth in all the developed world has been falling, which is why trend rate of GDP has been falling. So trend rate of GDP has gone from, the early 90s of 3% down to 1.75 now. So it's been falling because of demographics. But now you introduce workers or new productive units into the labor force, which is AI and robots, at infinite scale. If I look forwards, I only see an increase in AI and an increase in robots. We're seeing that in every factory around the world of the robots. And when robots have AI, they become even more productive. So this now mimics humans because you're infinite scaling of knowledge and applied knowledge. So therefore, it kind of solves the population problem. This is one of the reasons why China is talking so strongly about robotics as a core part of their future, particularly humanoid robots, is because they don't have the population growth. But this is a big answer. And when you do that, you start increasing productivity because productivity was dragged lower from demographics. The other part of productivity is the lowering of energy costs. Basically, electricity prices across the world have underperformed inflation. They've been relatively steady, except last year, obviously. So it's been steady. I looked at UK inflation prices for the last 50 years, electricity prices for the last 50 years earlier this morning, and they've been flat for a long time. But as we introduce more renewables, as we introduce cheaper renewables, there's a exponential downwards in cost in this stuff. It's just you can't do enough of it and you can't store enough of it. But as technology improves, the overall cost of electricity will come down. And so therefore, productivity is really the output per kilojoule of energy at a core first principles basis. So if your unit of energy cost goes down by half, it doubles your productivity. And then you add the AI, the robots, and AR, VR, genetic sciences, all of these things on top, and you get a miracle, an economic miracle. Now, that's not going to happen this cycle, but we'll start to see the seeds of it. But really after the next cycle, by the time we get to 2030, it becomes almost impossible to predict what economies look like. There's a group at Oxford University where Nick Bostrom, who's one of the thought leaders on all of AI, and where a lot of the work came from, there's an economist involved in that group that says, listen, if this continues to play out in the way that we think, and the trend continues, there is no reason global GDP can't double in a year and even double in a week. And I get it. It's directionally right.
Yeah.
But it won't be now. But that's what's coming. This is what I think gets us out of the debt trap. This is the whole idea of this exponential age thesis that I've got, is this nexus of technologies all hitting exponential adoption phase at the same time and kind of interwoven with each other, drive a productivity miracle, far and away larger than the one observed in the 1950s and 60s, which also got us out of the debt trap then, the post-war debt trap. Very similar situation. And it took us a while, a bit of yield curve control plus new technology. This time around, we might get yield curve control, but the new technology is really going to change everything.
The stock market's plight provides an interesting parallel to the cryptosphere. Raoul believes we'll actually see a supply-induced price collapse in the crypto world, but will lead to a positive market response. He underscores that market participants often focus on present conditions and narrative, losing sight of the forward-looking essence that drives crypto markets. Powell's investing philosophy capitalizes on these dynamics, advocating for long-term strategies during business cycle troughs. By adding to positions at long-term uptrends, investors can harness the potential for significant gains, even in the face of prevailing negativity. He emphasizes the role of liquidity indicators, which, when moving upward after hitting a bottom, signal a potential reversal and serve as key markers for opportune entry points. What do you think about the latest interview with Raoul Pal? And what are your thoughts on his insights regarding the future of cryptocurrencies and their impact on the global economy? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.